There we go. Coming into the day, bulls, they're getting the bull breakout of the overall April trading range. And strong enough breakout. Odds are probably going to go at least a little bit higher. You can see on the weekly chart. Over the next couple, we have consecutive bull bars here, strong bull bar here, consecutive bull bars, probably going to get a second leg up. And I think we'll probably end up getting back to 6,000 over the next several weeks. However, we could go sideways first. We may have to pull back, but after consecutive bull bars, from an always in standpoint, bears, maybe they sell below this bar, and realistically, they're probably going to get out above a bull bar, either this bar, certainly last week's bar. I thought this week would be disappointing. So my thought was we would form some kind of doji, a disappointment bar, and not create a strong entry bar. And now that we created a strong entry bar, that's a lower probability event, and therefore lower probability events typically get second legs. 5-minute chart. The Emini gapped up today, forming a doji for the first bar of the day, and we gapped up following yesterday's sell-off. Bar 1, doji, 2, doji. Bulls will see 2 as a high 1 buy, breakout pullback buy, and therefore they're hopeful that they can buy above it and that the market will lead to a second leg up. However, part of the problem I have with buying above 2 is so far you have a stop entry for the bears and a stop entry for the bulls above 2, and therefore it's a trading range, and therefore it's a lack of commitment for both sides. 3, bear bar, but a doji, probably buyers below. And then 4, bear bar closing on its low, trapping the bears that bought below 2, bought below 3. Good enough bar for the bears that I expect will probably get at least a small second leg down, and therefore probably okay for traders to sell it if they're aggressive, betting on a breakout of this tight trading range. They understand that the odds are we'll probably get an opening reversal, and big enough gap up, the odds favor a second leg, so we'll probably end up going above the bar 1 high. And then 5, bear doji, we've sold off to the downside and then reversed up. So bears buying back shorts, bulls buying. Sometimes, when you have, I want to say this really quick, so I think it'll be helpful. Whenever you have a really bad stop entry, such as something like 47. 47 is not ideal because we rallied 44, 45. We have a second leg up here, 50% pullback from this sell-off here. And we had a decent sell-off, 47, 48. And buying above 49, this bull bar is buying a high 1 buy right where the bulls got trapped. And therefore, if this trade's going to fail, there's greater risk that there's immediately sellers above. Buying on a stop 1 tick below 4 is not the same thing. 4 is a strong enough bar that it actually makes sense to sell below it. And whenever you get a bar where it makes sense to take the stop entry, it's reasonable to assume that the market's going to have to hesitate and probably at least attempt to get trend resumption down. Meaning, instead of buying the low of 4, what traders do instead is they wait for the follow through and see what happens. And when this bar starts to go down and stagger, meaning it goes down, finds a little bit of buyers, goes down, finds buyers, that tells the bulls that bears are buying back shorts. And what happens? More and more traders start buying, which can lead to this. 6, doji, low 1 short, but not a strong breakout, 3, 4, and 5, and therefore probably buyers below. 7, a bull breakout above 6, but after bar 4, probably sideways. And then 8, bull bar closing at, looks like it closed under the 7 high. Not a great bar for the bulls as far as context goes, but it's a micro channel, 5 low to the 8 high, and we're getting closes. The past 3 bars have a close at or below. Let me say it differently. Past 3 bars have a close at or above the close of the prior bar, and therefore that's trending behavior. And now we have consecutive bull bars with a high above the high of the prior bar, and that's good for the bulls. 9, bull bar closing on a tie, good for the bulls, increases the odds we're going to go at least a little bit lower, a little bit higher. 10, a doji, but probably buyers below. 11, high one buy, breakout pullback buy, good for the bulls. Okay, buy above it, betting that we'll get at least a small second leg up after the micro channel, 5 to 10, but really not a great buy signal bar. Forcing bulls to buy near the top of the range, the 1 high. And then you can see what happened with 12. 12, a surprise bar, but more likely climactic. It's the close of the 60-minute hour. And when you see a bar like 12, 12 is a good-looking bar. But if you just rewind to the prior bar, it's really not all that impressive of a rally. So 12, good bar, but probably exhaustion, probably going to lead to a pullback. Exhaustion typically means trading range, not opposite trend. And therefore, whatever reversal down we get is probably going to be minor. I think the biggest issue here on this chart for the bulls is the 60-minute moving average. We're so far away from it that the odds are we're probably going to have to get to it. And if we go back to, so there's a 60-minute chart. So the problem, this is basically the issue. Here's the high of the first hour, and here's the 60-minute moving average. We're really far from it, and therefore we're probably going to have to get closer to it. 12, bear bar, undoing the, 13, bear bar, undoing the rally on 12. Close above the midpoint, but strong enough sell-off on 13. We'll probably get at least a small second leg down. And then 14, we have a bear bar, good for the bulls. 14, we have a bear bar, but closing above its midpoint. It's good for the bulls. They prevented the bears from getting a consecutive bear bars, but it's really not a good high one. So the market sold off on 13, rallied, sold off on 14, rallied. So it's 2 legs down in a smaller time frame, but there's probably not enough interested buyers above 14. And therefore, there's probably more sellers above 14. 15, second leg down after 13, sold off 13, paused 14, sold off 15, closing below the 12 low, good for the bull. That's good for the bears. But we're close enough to the moving average that we may have to get there. Tight enough bull channel that I think there's probably more traders buying down here than selling. So does it make sense to buy the 13 low? Not necessarily. And that's because the 13 low, even though it's a bad sell signal bar, it's strong enough momentum down after consecutive buy climaxes that the odds are we're probably going to get another leg down. And so when you see that, if you buy the 13 low right here, the problem is it's probably going to form a high one on the rally. So if you buy 13 and you're long on 14, and now the market's up here, where's your target? Is it the upper third or the high of 13? It might be. But the issue is now, if on the close of this bar, if you're long, you're willing to buy above a high one. And you're buying a high one that is relatively late in a rally, and therefore there's probably more sellers above it. And that's why a lot of traders would wait for some kind of second leg down on 15. 16, reversal up, not a good buy signal bar for the bulls, but a warning that bulls are willing to buy the 15 close and below 15. And therefore, whatever sell if we get below 16 is probably going to find buyers. $17, bull bar, not a great bar for the bulls. Tail above the bar. Probably sellers somewhere above, but 1 leg down, 2 legs down, 3 legs down after a tight bull channel. Even though there's probably sellers above 17, I'm not willing to sell. Too much risk we got to test up to the 12 high. 18, bull bar closing on its high. Good for the bulls. May go a little bit higher. But bad buy signal bar, 17, lowers the probability for the bulls. And then 19, we have a bear reversal bar with a tail below the bar. Not all that great of a sell. And then 20, bear bar closing on its low. For the bears, it's a rally, trend line break to a lower high, major trend reversal, but probably not enough bars, and therefore whatever sell-off we get is probably going to be more minor. And then 21, bull bar, not a good bar for the bulls. By the way, these arrows, because some of you are going to watch the recording of this trading room end of day review, these arrows are where always in bulls and bears exit. So always in bulls buy here, and then they get out below this bar. 22, tail after the 21 entry bar. Not a great buy above 21, not good follow, not a good entry bar 22. And therefore, you'll have traders selling bulls that sold the 21 high, bulls that bought the 21 high, hoping for resumption up. They're disappointed 22, and they may look to just exit the trade. And that's why 23 sold off. 23, bear breakout, good for the bears, may go a little bit lower. 24, follow through consecutive bear bars, 23, 24. And a second leg down from the sell-off from the 17 low, leg 1, pullback, leg 2, increases the risk that there's more buyers down here rather than sellers, testing the open of the day as well. And then reversal up, 25, good for the bulls, always in bears. If they're short, they get out above 25. 26 consecutive bull bars, probably going to go get at least second leg up. Then 27, doji, not a good sell, probably buyers below. 28, follow through, and then 29, a bear bar. Really not a great rally for the bulls, but a problem for the bears. If you're a bear, I mean, what do you do here? You're probably not going to be selling the first reversal down from the rally from the 24 low. Bull bar 30, but close at the 29 high, or it looks like closed under the 29 high instead of above it. So really not great. Still in a tight trading range. We're still always in long. I didn't mean to do that. We're still always in long, and we're getting a lot of bars above the moving average. And you can see on the next bar, we got a fairly big climactic bull bar on 31. 31, good bar for the bulls, but climactic bar, 2 legs up, possible wedge, 1, 12, and 31. You can also just call it a bull breakout of a bull channel, which is basically the same exact thing. So here, you can draw a line. If I can do this correctly, you basically just draw a line right here if you wanted and say that this is some kind of bull. We have a bull channel here. And now we're breaking out above the bull channel. Not really a great shape though. But anyway, it is a bull channel. And here's a high. And I was trying to draw it a parallel to show it's not a good shape. But here's a high, here's another high. And we're trying to break above it. Bull break out of the tight trading range. But my one thought here is this is that bar on the 15-minute chart. Again, we're just getting more and more climactic on higher time frames. So right here, we have a bull bar closing on its high. Big bar, smaller follow through bar, and then another big bar. And we have a rally, pullback, and a second leg up. And that increases the chances that we're probably not going to go a lot higher without pulling back first. And therefore, I think probably 75% chance the breakout fails and we have to pull back and test the bottom of the channel. Not good follow through, 31, probably buyers below. Not a great sell below the bar. Or not good follow through, 32. Probably buyers below because of the tail, but I suspect there's probably sellers not far above. 33, bull bar closing on its high, but overlap with 32. Increases the risk that there might be more traders selling above rather than buying. And then doji, 34, bear bar closing on its low, 35. Second entry short with 32, 35. I think the always in bulls probably get out below 35. And then 36, 37, 38. Looks like we're testing. Let me start over. 36, not a great entry bar for the bears selling 35. Tail on the upper third of the bar. So 36 rallied and then sold off, and it's got more of a tail than a body. And it overlaps a lot of 35. So that's a sign of weakness by the bears. But because it's a consecutive bear bars, we'll probably get at least a second leg down, even if we pull back first. 37, bull bar, but after 35, 36, I suspect there's probably sellers somewhere above. And you can see what happened with 38, 39. 38, bull breakout above the 33 high, but then 39, bad follow through. Probably going to start to go sideways and test the moving average soon. And then 40, bear bar, inside bar, not a great sell below, but I think it's reasonable, certainly for the always in bulls to get out below 30, for the bulls to get out below 40, this inside bar right here. And therefore, if bulls get out, it's probably okay for the bears to sell, especially if they're betting on a double top, 34 and 49 and 39, betting on a break below the neckline and a measured move down. And then 41, we have a doji, not a great buy. Let me say it differently. 41, weak entry bar for the bears, not a great entry bar after 40. But a bad high one for the bulls buying above 41, and therefore there's probably more sellers above rather than buyers. 42, barrel bar closing on its low, and you can see we tested down to the moving average, 43, 44. 44, strong enough breakout, will probably get at least a small second leg down. And then we got the doji, 45, minimum follow through for the bears. But 45 is a pause, and therefore 46 sells off below 45. That would quantify as the minimum for a second leg down. And that's what happened with 46. 46 doji close above the 45 low. Probably more buyers in this area than sellers. And you can see the bears, the bulls broke to the upside above 46, but there were more sellers above, and the bulls managed to close the breakout point, the 43 low. Bulls buy the 43 low, disappointed 45, 46, disappointed on 44, 45, 46, and they used the rally on 47 to exit their longs at their original entry or exit their longs at the breakout point. 47, low one short, but probably more traders buying below it rather than selling. And then 48, a bull bar, but a tail above the bar. Not a great buy for the bulls. But because it's consecutive sell climaxes here, here, and here, I suspect that it's reasonable for always in bears to exit. Bear bar, low one short 49, but probably buyers below. And then decent bull bar 50, micro double bottom 48, 50, probably going to go at least a little bit higher. And I suspect we'll probably test back into this area up here. 51 consecutive bull bars, good for the bulls, probably going higher. And you can see 52, not a great bar for the bears. It's relatively small bar, and therefore I suspect most traders will hold below it. But if you're a bull and you got out below 52, you probably buy again above 53. And then where do the bears get out? I think it's okay to get out below 58, even though it's a relatively small bear bar. Other traders, maybe they get out the range of 58, twice the range of 58 going down, or maybe 5 points below the 58 low. And you can see we formed a high one on 59. 59, high one buy, but high in the range, probably not going that much higher before we pull back. And then 60, we tried to pull back, but weak stop entry sell for the bulls, for the bears, increased the risk of buyers below. And then we got 61, 62. For the bulls, they'll see 61 and 2 as the bull breakout above the 57 high and another open gap, and another negative gap, just like the gap from the 55 close to the 59 low. However, the problem is it's three legs up, 52, 57, and 62. And because of that, sometimes I have to pause when it gets later in the day. And anyways, probably a wedge, and I suspect always in bulls, probably selling out of longs. I made the comment, had I bought above 61, if 62 was my entry bar, I'd be pretty quick to exit. And the reason, several reasons. Climactic looks like a bull leg in a trading range type of day. We have this gap here that may get closed from the 12 high to the 48 low. And we're just so far from the overall over here. We had a high one buy. And I made the comment that it's kind of a bad high one. You know, you're far from the 60-minute moving average, way down here, and it's a high one by late in a rally. There's probably sellers above it, and the high of this hour over here, this bull inside bar, which was 13:30 Central Time, that's the bar 57 high. So I made the comment there's probably sellers above it. Doji 63, not a great sell for the bears, but 3 legs up, so the context makes sense. Bad stop entry buy above 63, so probably sellers above. And then 64, obviously strong enough surprise, probably going at least a little bit lower. And then we got bad follow through on 65. 65 closed at the moving average and near the 50% pullback of the 64 bear breakout. Increased risk of sellers above. And then 66 bear bar, but a doji, probably going at least a little bit lower. But this looks like a bear leg in what will become a trading range. And then good bar for the bears. Is it sell to close? It might be, but well, let me say it differently. It's not sell to close. What do you do if you're short? If you're short, you probably get out above a bull bar. The one danger with being short, 67, is you're selling at the same price level where a lot of traders started buying. And 64 is not clearly broken out below all the bars to the left. And that increases the risk that 67 and 68 may lead to a failed breakout of the 48 low in a reversal up. And you can see that's basically what happened over here. We formed a second leg down on 68, and then we reversed up to 72. And at 72, consecutive bull bars 70 and 71. I mentioned that you're in the middle of the range. It's probably best to do nothing. And then the rest of the day was just limit order trading. For stop entries, you can buy above 8, and then what else? I thought buying above 11 was okay if you understood it. You can buy above 9. Now the easiest, stop entry of the day is probably buying above 24. If you understand what's going on, you buy above 24, saying that's a strong enough breakout. We'll probably get some kind of second leg. So you buy 24, stop below 24, or you buy above 26. Stop below the 25 low, and you just see what you get. And then obviously you take profit somewhere up here. And for always in, bulls buy 8, probably get out below 20, and then bulls buy above 20, 25, and then they probably get out below 35. Bears, they may sell there and they get stopped out 38, but they sell again below, maybe below 40 or 42. And if they do, they get out above 48. Bulls, they can buy 48. They can buy above the bull bar 50. And they probably get out somewhere, really anywhere over here, maybe below 58. Limit orders, I thought buyers below 1, sellers above 2. I thought buyers below 3, but the buyers may not come in until we get closer to the moving average, and therefore probably better to wait and see what the breakout looks like. I thought buyers below 6, but it didn't trigger. I thought buyers below 10. I thought sellers probably somewhere above the 10 high, but tight bull channel, and it's a micro channel, 5 low to 10 high, probably better to wait. And then I thought buyers below 13, buyers below 14, buyers below 15. But, it's what I mentioned. If you're buying below 13, it's really better to wait for a second leg down. But, because the reason I'm saying buyers below is you will have some bulls just buying and scaling in lower. I thought buyers at the moving average on 24, and then I thought buyers below 28. That made sense. And then I thought buyers are probably sellers above 37 or the 36 high during 38 because of the moving average and the possible failed breakout of the bull channel. And then I thought sellers above the 41 high, 42 high, sellers above 45 for a small second leg down, buyers below 49 over here, and then buyers below this bar. I thought buyers probably below 52, but a tough bar to take. Part of the reason, I mentioned that always in bears get out below the bar, and they probably buy again above a bull bar, and that's true. Some bulls, they'll stay long, taking a chance it's a bad sell, and therefore buyers below. And then I thought probably sellers above 63, but it didn't trigger. I thought probably sellers above 65, but, really not. It's pretty scary sell, and that's why I said it's safer probably for always in bulls to get out above 65 and then sell again below 66. And then I thought probably buyers below 65, especially after this bar on 68. So bulls on 69, they'll buy the bottom third of 68 and then buy the close, sell the close, maybe buy the close 9, not perfect, but probably reasonable. I thought probably buy the close 26, that's probably okay. And you can buy the close 31. I would not. Climactic bar, probably going to go sideways at best. And then really that's probably it for buy the close, sell the close. A couple bars in here, but they're really, interim pullback bars. So, it's kind of like selling 64. Don't sell the close 64, sell the pullback. That's the better entry. Let me take a look at questions. And I'll have to be quick because unfortunately I'm running out of time here. But it looks like I answered a lot of I talked. So let me take a look here. A question. Brad, traders who scalp out of partial positions and leave other remaining parts for a swing trade, is the scalp part 50% or more likely, or more like 80% of the trade? So a trader that scalps, okay, I see what you're saying. So traders who scalp out partial positions and leave the other remaining, do they scalp half their position off, or do they scalp 80% of their position off? The way I look at it is, I'm not really I think it makes sense. I kind of look at it like this. If I'm trading always in and trading with stop orders, if I really want to be systematic about it, I think there's logic to taking profits at risk levels. So if the market goes 1 times your risk, take half off, or 2 times your risk, take half off. And all that depends on the type of trade. I have no problem with that. So take 50% off. And, I think realistically though, what traders really do, if you're really to sit down and ask the experienced ones, what they really end up doing is they increase and decrease their position size based on what the market is doing. So what do I mean? What I mean is when you have that 10% of the time and you have a really strong sell the close market or a really strong buy the close market, those traders are going to build heavy positions and the risk will actually be larger than what they normally are willing to trade. And the reason for that is the probability might be so high that the odds are, they may have an 85% chance of making 1 times the risk. And because of that, it's one of those kind of special circumstances where a trader can risk more than they normally would. And when the probability becomes not as good, such as up here, so when the probability, a bull might buy above 50 and build and have a large size, full size position. They buy above 50, stop below 48. But then when the market starts to go up here and look like a wedge and a bull leg in a trading range, a lot of those bulls are going to start reducing their position. And in this case, they might have a small position. For me, I generally like I'll trade maybe 1 or 2 position size. So sometimes I'll take half off, but a lot of times I'll just take the full thing off and then look to re-enter again. So if I'm up here and it doesn't make sense to be long, I'll exit the trade and then I'll just wait. So I made the comment, if I was going to buy above 61, I'd be quick to exit. I'd probably just buy a normal position above 61, stop below 61, and depending on what the market did would be depending on how I reacted. So I hope that makes sense. Okay, last question. You said could have bought above 25 here if you knew what was going on. What was going on? Well, yeah, you had a strong enough rally up. So the question was, why did I say 25 was good buy? You had a strong enough rally up to 12 that the odds were it would get a second leg. And even though 12 was, looked like a crazy buy, it was actually reasonable. So buy the close bulls, they buy the 12 close, and they wait for a credible bull bar to buy more above. And therefore, the odds were when you see this kind of a bar, 25, you're probably going to go above the 12 high. And we gapped up, we tested the moving average, and therefore, this is probably going to be some sort of channel, and therefore we'll probably at least get a new high of the extreme. All right, so where do we go next week? I think next week because of these consecutive bull bars, we'll probably get some kind of second leg. And therefore, if we sell off early in the week, I expect we might sell off early next week and try and form a tail on the bar. But if we do, it may form like this. So we form a tail on the bar and then find buyers. So there's probably buyers maybe at a 20-30% pullback of this week looking to buy for another bar or second leg up. All right. Thanks everybody for tuning in. Hope everyone has a good weekend.